Cost volume profit analysis is the topic that we will cover next, and this may be one of my most favorite in this section of the course because it's very applicable, and I think it will be very beneficial for you guys regardless of your future careers in accounting or business or whatever it may happen to be, in realizing how we utilize data to help make useful business decisions about a company. So some of the things that we will look at is determining, for example, how changes in volume affect cost. Okay, so the more we produce, the more it costs us to produce those items. So we'll look at how different types of costs change with volume. We will look at something called contribution margin. We should be familiar now with sales less expenses equal net income. We're going to break this down into more useful data for managers and look at something called contribution margin. We will also begin analysis of cost volume profit analysis. Okay, so what cost are we incurring based on the volume that's taking place in our organization, and how much profit can we generate depending on the volume. So like I said, very beneficial information that we can carry through with us. We will use this cost volume profit analysis to help us make decisions about what products we should produce, when we reach break even with those different products, and which ones maybe we need to promote more than others in our organization because they generate higher contribution margins. Okay, so lots of useful information. Let's begin with the first objective, which talks about how volume impacts our cost. Well, we're going to look at three different kinds of cost in this chapter. The first is variable. Variable costs are exactly what they say. They vary. Okay, so the more we produce, the more cost we will have. Fixed cost, on the other hand, just as it says, remain fixed. Okay, so regardless of the amount of smart tablets that we produce, our rent and our insurance and our supervisor salaries stay the same. Those are fixed costs. And then we will look at some mixed cost. Maybe in a trucking organization where you have a fleet of trucks that are hauling products for people, the insurance on those trucks, the property taxes on the equipment in that organization, those are fixed costs. It doesn't matter how many pounds you haul, those costs are the same. But the more you travel, the more you're going to spend on gas and oil and maintenance for that fleet of trucks. So we're going to look at how variable, fixed, and mixed cost impact our profitability and how we can better analyze these different types of costs to have control and make decisions in our organizations. So first of all, we mentioned those variable costs. Now, remember I said that the variable costs are exactly what they say. They're variable and they move with production. But when we see the first definition, it tells us that variable costs remain constant per unit. Okay, so let me explain that. They remain constant per unit, but they will change as volume changes. So in our smart tablet example in your text, if the batteries for each tablet cost $55, okay, then we have $55 per tablet. This is a variable cost because the more tablets we produced, the more our variable cost will be. So we can see this activity taking place. If I produce 0 tablets, 0 cost. 25 tablets, $1,375. 100 tablets, $5,500. Okay, so in variable cost, the cost per unit remain constant, but the total cost will increase or decrease with production. So there is a direct relationship between total variable cost and the volume that's taking place in our organization. We can see this graph in this next illustration that the more tablets we produce, the more batteries we will need. So here's our dollar line. The more we produce, the more we spend on batteries. So our variable cost line, we can see, is going to increase with production. On the other hand, fixed costs are right the opposite. The total cost and fixed costs remain the same. Remember, we mentioned the insurance, the depreciation, the supervisor's salary. So regardless of how many tablets we produce, the rent on the building and our insurance for the building, our supervisor's salaries are going to stay the same. So we see a fixed line for the fixed cost. And we can see in this illustration, once again, if we have total fixed cost, they are the same. We don't see any change. 12,000 in quarter one, 12,000 in quarter two, 3, 4. Right? So it doesn't matter if I'm producing 25 tablets, 50, 75, or 100, the fixed costs stay the same. However, if I want to know what my fixed costs are per unit, we take the total fixed cost divided by the number of units that we've produced, and what we see now is an inverse relationship taking place. Terrible arrow here. But the more we produce, the less fixed cost we have per unit, because now I'm spreading the rent, the supervisor's salary, the insurance out over more tablets. Okay, so like the note says on the bottom, total fixed cost remain constant. But the more we produce, the less it costs us per unit, which generates an inversely proportional change to volume. Okay, so if we do a comparison of our variable cost to our fixed cost, once again, we see that variable cost in total will change. They change proportionately in relationship to our volume. More volume, more tablets, more batteries, more cost. But the cost per unit remains the same. Each battery was $55 a piece. Okay, when we're talking about fixed costs, remember, in total, they remain constant. $12,000 per quarter, regardless of the number of tablets that we produce. But if we produce more tablets, if the volume increases, then our cost per unit decreases. Right? So there's an inverse relationship here. So this is a good chart to give you a comparison of those two costs. Now, sometimes we have costs that are not either completely variable or completely fixed. We call these costs mixed. Okay? Once again, just like it sounds. And this gives you an illustration and your textbook uses this illustration. Years ago, when we first had cell phones, you paid a base fee for your phone, and then you paid per minute. So in this particular case, what they're showing you are total fixed cost. You're going to pay $100 a month for your phone, and then $10 a minute for however many minutes that you use. Okay, or 10 cents a minute. They've converted this to 100s, but you kind of get the point. All right, so we have the fixed costs that are going to remain the same regardless of how many minutes we use, but we can see that variable cost will increase, okay, the more minutes we use. So if we use 100 minutes at 10 cents a minute, we have $10. 200 minutes at 10 cents a minute are $20. And so once again, we can see total cost increasing with volume. Okay, but the volume is being driven by these variable costs. When we put this into a graph, we can see now that, once again, remember our line here for our fixed cost. And so regardless of, this is using our telephone illustration, okay, regardless of how many minutes we use, okay, we're going to have our $100 base fee. So everything below this line are our fixed cost. But the more minutes we use, okay, we're going to pay for those minutes, and the more minutes we use, the more we're going to spend. These are our variable cost. But when we combine variable cost and fixed cost, we have the total cost for our service for using those cellular minutes. Okay? So sometimes we need to be able to separate those mixed cost into variable and fixed. If we're trying to control cost, fixed costs are very hard to control. They are what they are. Okay, it's really hard to just stop paying rent on our facility. Okay, but the variable costs are a little easier to control. So we need to be able to separate the fixed cost from the variable cost when we have mixed cost. And one of the methods that we're going to use to do this is called the high-low method. And so we're assuming throughout the rest of this text that costs are going to increase when volume increases, as long as we are acting within a relevant range. So if we look at the tablets that are being produced here, we look at our relevant range from the lowest amount of tablets that are produced compared to the highest volume. So our lowest quarter in producing tablets is 240. Our highest number of tablets that we produce happens in the third quarter at 480. So our relevant range happens somewhere between 240 and 480 tablets. And so we're assuming that costs are moving in a straight line, okay, within this relevant range. So in order to use the high-low method, it's basically coming up with a weighted average cost using the high-low method. We're going to identify 3 steps. Step 1 simply says, as we saw on the prior screen, what is your highest month and what is your lowest month in regards to levels of activity. So we're going to calculate the variable cost per unit based on our relevant range of the lowest month of activity and the highest month of activity. So when we had 480 tablets, our total cost were $19.60. When we had 240 tablets, our cost were $1,480. So if we take the difference in the highest and lowest cost of 480 and the highest and lowest number of tablets, 240, we can calculate a variable cost rate using this range, okay, the lowest and the highest, of $2 per tablet. Now let's back up to our screen. Remember, fixed cost plus variable cost equal total cost. Well, now where we're headed, we know the total cost. And now we have calculated a formula for variable cost. So if I take my total cost and subtract the variable cost, what is left has to be fixed. Let's see that take place. Okay, let's move ahead to the next slide. All right, how can we get total fixed cost? Like I said, if we know our total cost, and we do, and we know our variable cost, which we have just calculated, $2 per tablet, then we can determine what our fixed cost happened to be. So when we do this, you need to use the activity that took place in either the highest or the lowest month. It doesn't matter which one, but it needs to be one of those months that we have used to calculate our variable cost per unit. So they have chosen the highest. If we take our total cost for the highest period, $1,960, and we subtract our variable cost, how do we determine our variable cost? Well, they're $2 per tablet. How many tablets did I produce during this highest period? 480. So out of the total cost during that period of 1,960, 960 of those costs were variable cost, which tells me that the remaining amount must be 1,000. Okay, so regardless of which quarter we're operating in, my fixed costs are going to be $1,000. So I can use now my separation of variable cost and fixed cost to create an equation that we can use to predict cost in the future. So if I want to estimate what my total manufacturing maintenance cost is going to be based on the number of tablets that I'm producing for that period, I simply take $2 per tablet times the number of tablets. Okay, how many do you think you're going to produce? $2 times the number of tablets that you're going to produce plus the fixed cost of $1,000 for this particular quarter will give you an estimate of what your total manufacturing maintenance cost should be for that period. Okay, so once again, this only works when we assume that the business has a relevant range where the total fixed cost and variable costs per unit do tend to remain constant. And that relevant range, like we said, falls somewhere in between our lowest activity and our highest activity. And what we have to understand here is that once we get above our relevant range, so for example, if our relevant range says we can normally produce anywhere, we need to produce 2,000 units to truly utilize our space and cover our cost to break even, but we can manufacture up to 4,000 units with the capacity that we have. That's our relevant range. When I get into the 4,000 to 6,000 tablet range, I may need more machines. I may need more supervisors. I may need a third shift. Okay, so now my costs are outside of that relevant range, and we have to take those things into consideration. But throughout the text and throughout the rest of this chapter, we are going to assume, unless your book tells you differently, that we are making decisions within the relevant range of the operating capacity of the companies that we're going to study. Okay, take a break, take some notes, and we'll come back and look at this new phrase, contribution margin.